Good afternoon, everyone. This is Kim Schmidt, Executive Editor of Farm Equipment Magazine. Welcome to our latest webinar in conjunction with the Western Equipment Dealers Association, Iron Solutions, and West Texas National Bank. Today's presenters are Gord Thompson and Kurt Kleppel. Gord is a management consultant with WEDA's Dealer Institute and a former dealer principal, and Kurt is WEDA's CFO and the president of Equipment Dealer Consulting. Before they get started with their presentation, just a couple of housekeeping items. On your screen, there's a control panel with a Q&A icon. You can submit questions here at any time during the presentation, and then time permitting, we'll try to answer as many of those questions as possible. And then also, we are recording today's webinar in the event that you want to come back and rewatch it or have anyone else on your staff attend at a later date. All right, we are ready to get started. Thanks again for joining us, and you can take it away, Gord and Kurt.
All right, thank you, Kim, and thanks for everybody joining us for this next hour as we analyze the 2021 study. And as me and Gord looked it over, there's some positive results in the 2021 study compared to 2020, and we'll go over those in a few minutes. Just a brief update on the history and methodology of the CODB. We've been doing it since 2005. Around May 1st, we request data sent to participating association dealership members, and dealerships have a few months. I think we extended the deadline through the end of August this year, and then we assembled them and got them ready to go. And each year we try to get it a little quicker and quicker, and so next year we'll try and have this seminar in September instead of October. We want to thank the participating associations that participated in this year's study: Midwest Southeastern, Northeast, United, Western Equipment, and Deep Southern. And again, I'd like to thank Iron Solutions and West Texas National Bank for sponsoring the CODB study. As everyone knows, Iron Solutions has a software for trade-in values, which is a big part of this study, and we'll see what happened to inventory here in a few minutes. But Iron Solutions is a good product to have at your dealership to help maybe inventory turns and definitely to value your trade-ins that are coming in. And then West Texas National Bank, they provide floor planning for all your inventory needs, and also capable of doing mergers and acquisition capital in case if that is one of your needs. So again, thank you for both sponsorships. Here's a map that the CODB study covers. As you can see, it's about 80%, 90% of Canada and quite a bit of the United States on the East Coast through the Midwest and down south, and then upper tip of Washington, Oregon, Idaho, and Alaska. So it covers fairly good size area. The CODB study is used by dealers all over the United States, and it has a really big impact on a lot of things. And one of them was a floor plan interest deduction that was passed in that last income tax bill under Trump in 2016. The study was actually used in some congressional tax hearings, and the effect that the floor plan interest deduction, if it was taken away, what impact it would have had on the farm equipment dealers. So with the use of the CODB study and some information we sent to the congressional tax hearing, it helped with the floor plan interest deduction to be a part of still as a tax deduction for our dealers, which is a huge, I mean, it's saved them tons of money in taxes these past few years. Plus, it also sets benchmarks for the industry, and it also helps businesses in mergers and acquisitions to be valued fairly, and also helps in estate planning. We're seeing a lot of activity in estate planning with the unified gift and estate tax exemptions at 11.7 million per individual. There's a lot of people that are doing some estate planning, moving stock to trust and things of that nature, while that exemption is still high. And the CODB study is an integral part of doing the valuation that will be used for the estate plan and to be attached to the gift tax return too. And then also it helps DI trainers and the dealerships involved, because the dealers are benefiting from these training courses, and the trainers rely on these percentages and be able to compare the same size dealership with the dealership that they're doing consulting work for. And I think Gord has used it several times in things that he has done in the consulting world, and also when he's an owner of his own business. Is that correct, Gord?
That's absolutely right, Kurt.
And then we'll go to the next slide. The CODB report is mainly 4 reports. It's individual association reports that go out to the participating associations that took place, and we went over those associations in the previous slide. And then also it includes a North American report for the North American averages, and just to make sure that we've got the volume segregated, as I was telling you earlier, that you can pick your dealership size and compare it to the others. We were going to change these volumes this year, but we didn't get to that. But next year we're planning on changing these volumes. In fact, we're probably going to go from 50 million and under as low volume, 50 million to 150 million mid volume, and anything over 150 million would be large volume dealers. And we'd like to have some of your guys' input that are on this webinar on the different volume categories that you'd like to see, the three ranges. So if you would, we'd appreciate your input on that. And then, of course, there's charts and graphs that are very instrumental, which shows a 5-year history, which is a pretty good indicator of the ag industry. Looking at a 5-year period, you usually see the ups and downs. And with this 5 years, it still includes 2015, 2016 year, which we all know we had the used market go down. And so, again, it shows a good parameter of the industry for a 5-year history. A few things to note: all these are averages by location, per location basis. The data is converted, since we have Canadian dealers, to US dollars. And the 2021 report is for 2020 data, and the 2020 report is for 2019 data. As far as mergers and acquisitions, keep talking about this each year. As you can see, average locations per dealership organization's gone up again, 5.21. And it's still trending in 2021. There's quite a few mergers and acquisitions in 2020, and I can't see it changing really. I still think it's going to happen in 2021. We're still seeing it. And I think it will continue on in 2022. We're starting to see other manufacturers kind of push their dealerships to look at consolidation and merging. So I think it will definitely be, that number will probably grow to 7 or 8 to 9, 10 times, average dealerships per organization, because you got some dealerships that are, 30, 40 locations. And of course, there's still quite a few that are 1s and 2 locations. So, this is, again, the average.
Thanks, Kurt. Just a bit of a recap of what we've seen in the last year. I think all of you have experienced this, but basically business was strong once we got over the initial shock of what COVID meant. And there was a bit of a period of slowdown when nobody really knew what to expect, and then things started to roll. It resulted in some pretty challenging operating conditions with restrictions in some situations, and it made it, when you had people working from home or whatever the situation was, it got a little more complicated to run your business. There were other complexities that also were attributable. We saw orders delayed on everything. The staffing issues that we mentioned, and part shortages, could certainly play havoc in a shop and things like that. The other thing that we're seeing is that as farmers get bigger and as multi-unit deals get more common, those deals are a lot more complicated. There's a lot of rules around them and a lot of hoops you have to jump through to qualify. And it takes a lot of management skill to ensure those deals meet the criteria. And that's added some extra work, I guess. And as most of you know, on the big unit deals, you tend to not make more margin percentages, but the deals are bigger, and so hopefully you're making the margin dollars off of a bigger deal. And yeah, we expect that locations per organization to certainly increase, and it probably got restrained a bit by COVID because there were several deals that kind of got slowed down due to logistics that we see going forward as we move into this year and next year. First, we're going to look at total sales, and wherever you see the red exclamation mark, that's an indication of what I would call a major improvement, and you'll see it on some of the other slides as well. Very exciting to me to see 3 of those on one slide. Basically, our used equipment was our driver for whole goods increases this year. Because we had it, we probably could have sold more new if we could get it, but we sold essentially what was available, I think. And so we look at a whole good sales increase of 13%, which put us into that 12.5 million range. And I'm particularly excited that basically parts and service kept up with the total sales increase of the entire store. And that's kind of unusual. You don't usually see aftermarket keep up with significant jumps in whole good sales. So that's a big tip of the hat for that performance, because it takes a lot of effort to get those departments moving ahead that fast and to create the capacity to do that. So those are all good. And when we look back at it fares well compared to the past 3 years that I've got on the screen there. Kurt, what do you see?
Yeah, I think we talked yesterday. I think the one reason why used whole goods increased a big percentage and new didn't is that we all realized that new inventory was kind of hard to come by in 2020 and still is hard to come by in 2021. So that helped customers move to the used whole goods items, which is good because it really brought down the inventory levels, which we'll talk about in a few more slides. But again, as we talked yesterday, I think, you travel all across the United States and even Canada, it's probably the barest I've ever seen any dealership lot ever in my 40 years of being involved in the industry. I mean, it's unbelievable, really.
It is. The equipment lots look a lot like the car dealer lots. There's just virtually almost nothing.
Yeah.
All right. This slide looks at the left side. It talks about total asset turnover, and the right side, it's parts and whole goods inventory turnover combined. So we see that asset turnover increased a little bit, and it's a little bit under our target. It's okay. It wasn't a major change, and I think that this year some dealers did some additions to their organizations, maybe added some equipment, upgraded some facilities, did some things that increased their asset level because they had decent cash flow and had the ability to do that. When we look at the inventory turnovers, we see some fairly big improvements over last year, but getting back to where we were 2 years ago, I guess. So there's that over 3 times turn on whole goods on total inventory on the over $75 million dealers. Would maybe argue that inventory target should even be 3.5 times, maybe 3 for new and 3.5 or 4 for used, perhaps. I guess going forward that the availability of new is probably going to really drive what our new turns are, and that number could get really low as a lot of stuff gets pre-sold. Kurt?
Yeah, I mean, this is really good to see on the inventory turns, because after last year, the fiscal year 2019 or the 2020 study, the inventory turns were really pretty low, and now to see them back in a better spot than like they were in 2019 is really impressive. And then also just to comment on the asset turnover, one of the reasons why, well, two reasons why it didn't increase more dramatically than from 2020 are two things. There's an increase in fixed assets. So like Gord mentioned earlier, they're buying more service trucks and service equipment and maybe doing some leasehold improvements and things of that nature. We did see an increase in the fixed asset area. And then also, which is good, we saw an increase in cash, and that's always good. So when you can sell inventory, move your inventory and turn it into cash, there's nothing wrong with that.
The one thing that's on the horizon that could make life interesting is the uncertainties on delivery dates and new equipment can make it more difficult to pre-sell trades. And it could be complicated next year if you're trying to figure out whether or not the new unit that you sold customer is going to be here in time for you to be able to sell their trade. I mean, everybody always hopes for that and plans for that. But if it's not, you kind of have to wait before you pull the trigger on selling the used. And there's kind of a cascade effect there, because if you knew now that the new is going to be here in plenty of time, you could sell the first trade, maybe get the second trade gone. And now you're a little bit, it gets more complicated downstream to, when you're saying, well, I got a deal on the first one. Now I got to go try and sell the first trade. And maybe I'm going to try and sell the second trade. Well, there's a lot of ifs in that equation, and it gets a lot harder to fine tune and put through. So I think there's going to be some stress on used turns for just based on new equipment availability or delivery dates, because a lot of stuff the manufacturers just don't know when they're going to get certain components, and it's making their lives difficult.
Yeah, that's true. I mean, we've been hearing from dealers that, they're worried about, this coming next 2 months in 2021, because they don't know when the new inventory is going to come, and they don't have much on the used lot. So the producers are still having a good year in 2021 and need some tax deductions. So it's going to be interesting to see how that shakes out in November and December. You need at least a serial number to put it on the counter ticket, but so it's going to be interesting to see what the sales actually turn out to be in November and December of 2021.
Okay, when we look at whole goods inventories, the number that jumps out for us is the percentage of total assets in new equipment is down 10 points from last year, and kind of a historically low number. We had a big used sales, but we're just kind of on the low end of the range of used equipment, but it's good. So total new and used equipment is 57% of total assets. So that's really good, and we're expecting that probably, if anything, to go down just due to demand and availability.
Yeah, I mean, it's really good to see that it is that low, but then at the same time, it's kind of a little scary too, because you need inventory to make sales and to make money and to make profit, of course. So, I think that's probably the lowest we want to see it ever, is 57% of total assets. So, hopefully we'll see some increases in 2022 study with the 2021 years, but the way 21 is going, that I would agree, Gord, that might be a lot less next year.
Okay, when we look at dealership equity as a percentage of total assets, we've got the North American average on the left, and then we've got split by the dealer sizes. Our target number is 30 to 40%. Of course, that can vary pretty wildly in individual situations. The number is high. Again, consolidations that were kind of planned maybe didn't happen, so some money didn't get spent on it on additional dealerships. Even when you wanted to do your fixed asset addition, sometimes there was limitations on availability of what you could get, or there was delays again in supply chain. So, and again, when things are a little bit uncertain, which COVID certainly caused a lot of uncertainty, people tend to avoid making the big decisions. And I think some of that's reflected in the fact that equity's gotten to quite a high number because everybody's waiting to see what happens. And when you're not sure, you're extra careful. So that's part of it. Obviously coming off a good year. But that 2.88 million of equity per location is a pretty nice number, and it bodes well. When you look at the split by locations or dealership sizes, you'll notice that under 25 and over 75 are strong, and it's quite low for the 25 to 75 million. And when I first looked at that, I was really scratching my head as to why that might be, because everybody's made money in all the categories. And Kurt had a really interesting take on that, so I'll let him explain that to you.
Yeah, on the middle volume dealers, when looking at the detailed equity that was sent in, we saw an increase in treasury stock. So that tells me that there's quite a few shareholders that were being bought out in this volume of dealerships. So that, that decreases the equity and of course, decreases cash or increases notes payable to the bank, to finance the buyout. So either way, it's reducing equity. But we did see a big increase in treasury stock. So that tells me that a lot of shareholders were being bought out in 2020. And it's probably good reason. I mean, with the pandemic and at the age that some of our dealership ownership is, they probably said, now's the time to get bought out. And that's what happened. So that was probably the biggest decrease. But, you look at the other volumes, they're fairly steady, and the middle volume dealers, last two or 3 years, as you can see, 18.7, and then they jumped up in 2019 or 2020 study to 24.5%. But then again, they went back down in 2021. But that's not a bad thing, since it was due to some shareholders being bought out. So, they're still making money. And I wouldn't be surprised if that percentage goes back up to 25 or 26% next year.
Another way to analyze that is to look at debt to equity. It's just an alternate view of similar numbers. And our target for debt to equity is 3.3 or less. It kind of does two things when you have low equity. It leads to a higher return on equity, because you don't have to have very high income to have a fairly high rate relative to your equity rate. But it also can mean that cash can be tight in the cycle if there's a wobble in the cycle. So you kind of got to be careful going forward if you're in that situation to work your way through that.
Well, I think this, with the middle volume dealer, you see at 5.14. I mean, that even justifies more about the shareholders being bought out, because that reduces equity. And then again, a lot of those deals are financed through the bank, because they're over a period of years that they buy them out. So, this debt to equity at 5.14 does not surprise me for the middle volume dealers, but the others are looking really good, really strong. And again, next year in 2022 study, I think that will change for the middle volume dealerships.
The third way we have of looking at that is debt to asset ratio, which is your leverage. This is kind of a determination of what your ability to raise funds are, and kind of a generally accepted number is at less than 80%, you can access more funds, and over 80, it gets a little tougher. So I would agree with Kurt. We're in a short-term situation where those mid-sized dealers need to generate a bit of cash for a period of time to pay off some debt, and then they'll be back in a good situation. The other two categories are very strong at the mid-60s and lower. And it's just a fact of life that if you have a high leverage, it's you've minimized your opportunity to borrow more credit. Okay, whole goods gross margins. So what happened in the past year? We sold more. Our margins went up a bit, half a point on new and 0.7 on used, resulting in a net half a point on total gross margin. So good. Back to kind of where it's right in the range where it's been for the last few years. It was an improvement, but it was off of a little bit of a lower year. So what did it tell us? It tells us we sold more, not that we made more money on individual deals so much, what I would say. But when you look at the gross margin dollars, I mean, 728 is $150,000 higher than 588 per location. So that's a significant improvement there. So good results, but we didn't do anything radical on new or used margins.
Yeah, I mean, I think everybody would sure like to have, 7 or 8% on new equipment and maybe 6 on used for a total average of, 7 or 7.5 to 8%. But, at 5.8 is for total is pretty good. In fact, it almost reached the 2019 study at 6%. So, good. It's a good comeback, especially from last year. So I think, this year sales should, from what I've heard, the sales volume's there. So hopefully the margin is there too, or even better. So, maybe next year we might see these percentages increase, Gord.
I'm happy to see that the spread between the new margin and the used margin is narrowed. It's gone from 2 to 1.8. I always like that to be close. Closer is better. When you see a big spread, it usually indicates that you had to dump some used and you took a hit on it. So that's good. The other factor that we think played in on this is this equipment has gotten pretty expensive based on what dealers have to pay for it. And the more expensive the unit you sell, the harder it is to get more margin on the bigger dollar deals. And but if you're selling pieces for bigger dollars and you can maintain your margin, well, then actually it works out pretty well, as is indicated here. To look at aftermarket, we'll start with parts. So parts had a 12% year-over-year sales increase, which is quite nice. Very happy with that. They did a good job in increasing part sales to maintain the part sales mix at 16.7. Our target is 20, but that's been a long-term project to try and get it there, and we keep working on it. But we really noticed in the last 3 or 4 years that there's been heightened interest and focus on aftermarket as dealers have realized that they just really got to generate more dollars out of the aftermarket in order to make their businesses a little more bulletproof. And we're seeing it in what happened in aftermarket this year. They didn't just run away on new and used and then forget about aftermarket. The aftermarket kept right up. So this is good to see. I'm really happy with this.
Yeah, I mean, with these type of increases in part sales, it's indicating to me that more dealerships are spending some more money on training their parts people and be able to increase their margins and also increase their sales. I mean, that's a big jump, 2.5 to 2.8 in parts sales. And, that's pretty impressive. So there's got to be, there's some reasons for that. And I think a lot of it is training of their employees to generate more part sales. And then also, I think the fact that more used equipment was being sold, that there's also probably some parts that are being increased because of that.
Okay, when we look at parts gross margins, I would say the parts margin increase, that one knocked it out of the park. I did not expect to see that level of increase in 1 year. It's well above our industry target. I'm highly impressed. It takes a lot of right things to happen in order to improve margin, because you can't just blanket increase your pricing. You have to figure out where to focus on and where you can get it and where you can't. And you got to stay competitive in a lot of areas. And it's a big job. When we look at our total margin dollars going from 790 to just over $1 million, both of those are big accomplishments. what we see is that probably 2/3 of our margin dollar increase is due to our margin percent increase, and 1/3 of it is due to sales. When we look at our cost of sales of parts, 1/3 of it is just due to selling more. So excellent job on parts margins were done in that industry this year. I'm really thrilled about this one. I did not expect to see it.
I mean, usually when you have increase in sales, it doesn't always equate to increased margin dollars or margin percent. But in this case, it does. And that's terrific. And like you said, 35.3%, that's fabulous. I mean, 32 industry target and considered great, but 35.3, I mean, that's remarkable. And hopefully that'll stay or even increase in the next study, which it could. We could maybe see 36 or 37%. That would get a lot of people excited, I think.
Well, so much of it just hits the bottom line. It's just amazing what it allows you to do.
Yeah.
When we look at service sales, 17% increase, that's fantastic. I mean, that's a ton of work to increase service sales. I mean, that probably involves increasing staffing and everything to accomplish that. That's a big nut as well. So we went from just under $1 million to $1.16 million, $1.17 million. In fact, the service sales mix increased from 6.5 to 6.9. Again, our dream is 10%, and we'll have to work to get there, but we're moving in the right direction, and this is a major accomplishment.
Yeah, again, I think the dealerships are paying more attention to parts and service as indicative of this chart and the previous one on parts. I mean, ever since you look at 2018 at 667, and now it's up to 1.166 in 2021 in 3 or 4 years. I mean, that's pretty good, steady, healthy increases. And so I think, dealerships are paying more attention that, parts and service is a big key to the dealership bottom line. And again, I think we talked yesterday that with this service revenue growth, I think there was, we talked about more employees, which we'll see in some screens coming up, but really good productivity.
Looking at service gross margins, there is a blip here. Industry-wise, this target, you'll hear targets anywhere from 60 to 70%. And I mean, the general thought is more is better, obviously, but part of the concern on labor pricing is if you get too wild on it, you're going to sell less, and you're better off to have a price and volume mix that works rather than just go for straight high price and super high service margins. So what happened was we lost significant parts service margins, service gross margin percentages this year, and it's a real anomaly. But when you think about it, the situation we went through, where there was a lot of things happening in dealerships, where there was changed conditions with COVID and lots of rules and people at home and customer concerns, and there was a lot of hoops to jump through to run a dealer service department, even a parts department, but especially a service department in the past year. So we're thinking that this contributed to the decline in margins because it was just not all billable time due to new process and procedures and a lot of things going on.
Yeah, we talked yesterday about the pandemic and what effect it would have on these margin percentages, especially in the service area. I mean, as we talked yesterday, if you had a mechanic that contracted COVID, or even a family member of his contracted COVID, I mean, you were looking at, at least a 2-week period where they had to be in isolation. And so, you're paying them for those 2 weeks in isolation, and, they're not doing any billable time. So I think that's part of it. And then plus the fact that the dealerships invested in quite a bit of money with all the new requirements that were litigated to the dealerships to make sure everybody's safe and the customers are safe. So there's quite a bit of money spent, and some of that might have got charged to the service area and some to the parts and some to admin. But again, the pandemic, I think, had an effect on the margin.
Okay, here's another bright light for you. Total expenses went from 2.22 million to 2.28 million. So expenses went up just under 3% in a year where total dealership sales went up 13%. Consequently, their as expense of total revenue went down to 13.4. This is a great accomplishment because, there was costs incurred due to COVID, and there was processes and things done that added to our expense. I think this is a huge accomplishment. I'm really excited about this number. And when you look at that 1.2% decline as percentage of revenue, well, that's all straight to bottom line, and you'll see it when we look at total profits. This is a really good outcome and the best probably in a long time.
Yeah, this is good to see because, when you can control the expenses, you can't control a lot of things, but the things that you do have control over and you see these results, it's huge. And 13.4%, we're getting closer to that target of 12.5. So I think maybe next year we might see 12.5 or less in that category because it's starting to trend, especially in the higher volume dealerships. Some of those guys are operating at 10%, operating expenses. So I think we'll start seeing that come down some.
Okay, we're looking at profit from operations here, which, to be clear, is not net income before taxes. This doesn't include other income or volume bonus or other expenses. But this is what we're focusing on. And we've got it with the average dealer on the left, and we've got the also split by dealership sizes with operating profit as a percentage of revenue off to the right. So we're looking at a target of greater than 4% operating profit. And I like to think of 5% on NIBT as a good NIBT target. So we went from 237 last year to 492,000 of operating profit. Pretty excited about that. Nice numbers across the board. Little lower in the mid category, but that group seems to fluctuate from one year to the next, and it's kind of hard to predict. But when we look at the totals, it's been what I would call a very successful year.
Yeah, I would agree. I mean, with operating profit of 492 and then the percentages overall, I mean, the average dealer 2.9%. That was a good, steady, healthy increase over last year, 1.6. And even, you look at the last 5 years, I mean, it's the highest percentage of every year. So it's a good sign. Okay.
How did that all translate through? Well, it translated through pretty well. Even though assets increased, our return on assets is up substantially at 8.3% and getting closer towards our target of 10. So nice job there. And when you look at the history, it's far better than it was, 3 or 4 years ago. I mean, when you're in the threes, that's a miserable return on an asset. And equally good on return on equity. And equity's overall pretty high, so that tends to downplay this number and actually increase substantially regardless. It's 25.7. We haven't seen this in a decade or so, anything in this level. So these are exciting levels. It gets you excited about going to work.
Yeah, you're right, Gordon. And like I say, the huge increase, and you look at the last 5 years, I mean, it's tremendous increase. And you're correct on the return on equity. I mean, the equities have increased on the dealership level to get 25.7% return on equity is big. I mean, it's huge. And return on assets, you could predict that going up a little bit just because of the inventory levels,
Right.
but where return on equity is a different issue because you got the equity still there in most cases and the income coming in. So it's a good picture. It's a good place to be.
I completely agree. Okay. Our last analysis slide here, our employee average numbers are we've got revenue per employee is just slightly up from last year. Total store revenue is up, almost $2 million, but we added some employees to allow us to do that volume, obviously. The target is between 750 and $1 million, depending on whether you're big equipment or not. Most of our participants are big equipment dealers. So we would still like to see that number higher, but it's in the right direction.
Yeah, I mean, at 754 per employee, I mean, it's on the low end of the target, but still, I think it's pretty good because, as you say, the volume dealers that we have in the study, I mean, we do have large ag dealers in the study, of course. But again, that, and also the employees increase, so that drives it down some too, Gordon. I mean, 22.6, it doesn't seem like a whole lot of increase, but that does drive it down. So it's a good thing that, the employees part increased and kind of maintained the revenue per employee. In fact, it actually increased over last year. In fact, over the last 5 years. So good direction when you can keep the employees increasing and keep increasing the revenue per employee. So.
Exactly. Okay, this is my last analysis slide. So gross margin per employee, we're showing it here split out with 3 categories. And you can, as expected, you tend to see more sales and more gross margin in the larger dealerships. And it just shows that it's kind of like the last slide, it's kind of status quo. A couple of the numbers are a little bit lower, but those, I think last year was a little bit was higher than normal, quite a bit higher than normal. And we're kind of at about where what we would expect to see, I would say. Some good numbers.
Yeah, I would agree. I mean, in 2020 study, I mean, especially for the high volume dealers, I mean, the gross sales were tremendous. So that's what drove that number up. And then plus the employees were down too in that year.
Right.
So it's still, I think I would agree that it's about what you would expect volume wise. And, the low volume dealer, I mean, they're pretty consistent year after year. I mean, you look, except for 2017, $72, but for the last 4 years, they're fairly consistent. And the high volume, somewhat consistent too. Middle volume, just kind of unpredictable, so to speak. So overall, like this is a fun report to be analyzing because it's exciting to see progress that was made, and obviously a lot of hard work went into it to generate these results. Because some years we sat here and talked about it, and it was a little bit grim, but not so this year. So I'm happy. Yeah, I think what's going to be interesting, Gordon, we talked about this yesterday, is what's going to happen in the actual year 2021 and what we predict might happen. And, I think, the supply chain and the inventory levels are definitely going to enter into it. But I do know that all across the United States and Canada, that the dealerships so far have had pretty good years, and sales have been fairly close to last year, if not maybe even more. So
the Western Canadian dealers were targeting to be, I think we're expecting kind of a record year until we ran out of moisture in whenever that was, July. And we really ended up with not a very good crop, down about a third. Mm-hmm. Prices are strong, so that's compensated in a lot of ways, when crop prices being so good. But it could have been fantastic. It ended up being, I think, quite good.
Mm-hmm. Yeah, and in the United States, again, I think, from what I've heard, that, the sales are just as good, if not greater. But I guess, the big key is the last 2 months of 2021 year or the 2022 study. And, how much money are they going to make in the last 2 months, or how much money are they going to lose in the last 2 months? And it all depends on inventory. I know parts and service will still provide a good bottom line the last 2 months. So that's something to look forward to, I think, for sure. And then hopefully they can get enough inventory to move.
I have heard of some dealers that have gotten so tight on especially used tractors, that they won't sell them out of territory, even to anybody. So, because they're just trying to preserve some inventory for their regulars. So obviously there's going to be some inventory challenges in the coming year. I think combines wise, in our market, there was a lot of used combines available, but everything else was relatively or very good.
Yeah, and I think, you talk about keeping inventory in your territory. I think that's all over. I don't think you see a lot of inventory moving. A couple of years ago, you saw quite a bit of inventory moving from U.S. to Canada and vice versa, but I don't think you see that happening right now.
I agree. Okay, we'll go into a bit of the follow-up information here. Well, parts and service. Sorry, I missed this slide. This is another great outcome. Our absorption was fantastic this year, probably a record level. When you get both departments firing on, big increases, I was kind of astounded to see a 10% increase in absorption for your average dealer. That's remarkable. I didn't know that was possible. And again, well done, because those are long-term projects to make those numbers better. And every category across the board. I guess the small dealers didn't change really. They were pretty flat in that regard, but the other two categories are up significantly, and that's huge. That's big bottom line dollars right there.
Yeah, I think this slide just bears weight to the other previous slides on parts and service and how important it is to the dealership, and with the increase in sales and margins and things of that nature. I mean, that's why you got this absorption rate increasing, not only over the averages, but mainly, over the volume categories too. I'd say the low volume dealer, 5.38 to 5.72 is not a whole lot of difference, really. Right.
And yeah, I'm pretty thrilled with this. This is the Dealer Institute team plus Kurt. So just a picture of who our team is and is involved. Kurt, I'll let you take it from here.
Yeah, and with the DI, you can see the parts and service and customer service and leadership classes, and Gord with financial management and help with mergers and acquisitions, and Jim Vicente and customer experience and things of that nature. And then, of course, it's headed by Michael Piercy, and then Jennifer Luce, our Chief Operating Officer of WIDA. But all these guys can come into your dealerships and do these programs and also help your bottom line. So I highly recommend you talking to Michael Piercy about your concerns in your dealership, and we can get somebody there to help out and increase your bottom line. Now, I guess we can open it up to any questions and answers. And again, I'd like to thank Iron Solutions and West Texas National Bank for their sponsorship of the CODB study. And Kim, I guess I'll turn it over to you.
All right. Yes, we do have a few questions that have come in so far. And then just a reminder to anyone else that there's a Q&A icon on the bottom of your screen that you can use to submit questions. First off, on the revenue per employee and gross margin per employee, is that total employees or just based on revenue producing employees? So sales, service techs, parts counter people, or is it total, the
It's a
dealership
total,
50 employees and counts all of them?
yeah, it's the total employees per location.
Okay. All right. Then the next question is, how much does the M&A activity affect the contributors to the study? Would that account for the variation in the middle category, i.e. a different mix of dealers because some were acquired or merged?
Yeah, I think, each year we kind of go back and forth on the middle volume dealer and what causes their increases and decreases, and I think some of their increases are because they have gone through a merger and added 5 or 6 locations, whatever. And so they start seeing some increases in their bottom line and margins. And then, the following year, they kind of go into to where, like this past year, we see a lot of shareholders being bought out. So that affects all the numbers too. So I think, yes, M&A activity can affect some of these numbers. And of course, the dealers that are 10 and 11 locations and they add 10 or 15 more locations, of course, that's, you're adding all the volume as long as they can keep their consistency and control their expenses and keep the same atmosphere that they had in their previous locations. And that's going to increase those numbers too. So I think, yeah, the mergers and acquisitions definitely affect the CODB study. Don't you, Gord?
Oh, absolutely. Yeah. And even the lack of it, which I would say happened last year, kind of affects it a bit too.
Yeah.
But last year was just what was planned will be happening now and happening in the future. So it just delayed it. It didn't stop it.
Yeah, I think, with the 2020 study, which was a 2019 year, there's quite a few mergers and acquisitions that year. 2020, we didn't see quite as many because of COVID, but there still was some larger transactions done in 2020, if I remember correctly, where there are some acquisitions of, 20 some location dealerships. So, I don't know how much effect that would have had on 2020 impact, because I think it happened middle to the end of the year 2020. So, yeah.
All right. Next question is, did you gather information on CEWS payments and how much that improved bottom lines?
Yeah, on the government payments, that was in other income. And I think it didn't really affect the 2020 because a lot of them didn't get forgiven until 2021. So I don't think it had that big of an impact on this study, but next year's study will probably have a separate line item to recognize that, so we can kind of see what that contributed to the bottom line. But again, a lot of the PPP loans and government assistance didn't get forgiven until 2021.
In Canada, your revenue had to be down a significant threshold to qualify for any significant assistance, and I doubt that many dealers would have qualified for that. They would have had bigger issues if that was the case.
All right. And then can you guys just kind of review again the states and provinces that were included? Is that based on other regional association participation in the survey?
That's correct.
Okay. And then this is sort of forward looking to this year's results, but any indication of what farm taxable income is going to be in 2021? Do you see a lot of customers needing some tax-oriented Section 179 driven capital purchases in the fourth quarter of this year? There will be issues with availability of equipment by year end for a lot of folks.
Yeah, I mean, that's what we were talking about earlier, whether or not what's going to happen these last 2 months, November and December, and how much inventory you will be able to sell to the producers that are having pretty decent years and are looking for Section 179 write-offs and bonus depreciation, which is still in play as we talk. I don't think Congress has the time to change the tax laws to where it might not happen. But again, it's all going to depend on the inventory levels. And as far as the dealerships are concerned, yeah, we're seeing more dealers investing in fixed assets, whether if that's service trucks or, leasehold improvements, things of that nature. But they're all looking at, what can we purchase and get bonus depreciation on to help with the tax burden and the net income level. So I hope I answered that question.
All right. And then our next one is, did you include the precision department? If so, where does that revenue get classified?
The precision is in service.
And then I think 21 will be a good year. Do you have a concern for dealer profitability in 2022 with inflation we're experiencing and margin compression for farmers in 22?
Yeah, I would. Those are real big concerns that I have too, is inflation and then the availability of inventory. Of course, I think it's going to take a while before we see that change. So I'm concerned about the profitability of 2022 more than 2021, of course, and 2022 is going to depend on how much inflation keeps increasing. I mean, we're at 5% inflation, I think, right now in the United States. And, if it jumps any higher to 7, 8, 9% inflation, that could be a real big concern. And then also I'm concerned about, getting employees and hiring more employees. I mean, everyone that I've talked to, they're looking for more employees and they can't find them, and it's just it's changed so I don't know. It's a big concern because employees are a big key to the growth of a business, and if you can't find employees and have that, then it is going to affect the bottom line. I don't know if Gord has anything to add on that.
Well, it's a big issue in Canada. I can tell you, there's this. It's hard to get people. It's really hard to get people right now in every area of the business world.
All right. This is more just a comment than a question, but they agree service gross margin drop is due to productivity drops. The cost of goods sold is tech wages, so the margin dollars are up, but the percent is down.
Gord, do you want to?
Well, that's logical too. I mean, if you're forced to increase your tech wages, it decreases your service margin, and there's certainly pressure on that area.
All right, that is all the questions that have come in. So I think we're just about under an hour right now, so we can wrap things up. Thanks to everyone who attended today, and thanks to Gord and Kurt for the presentation. Like I mentioned earlier, today's presentation will be available on the Farm Equipment website in case you want to go back and review it. Watch your email and the Farm Equipment newsletter for more information on that. On behalf of Gord, Kurt, the WIDA Iron Solutions and WTNB teams, and the Farm Equipment staff, thanks for joining us for today's webinar. When you leave, there'll be a short survey. Feel free to let us know what you thought of the event and reach out and let us know of any topics you'd like us to cover in the future. Thanks again, everyone, and enjoy the rest of your day.
All right. Thanks, Kim. Thanks, Gordon. Thanks, everyone.
Bye-bye. Thank you.